Welcome back to the Deep Dive. Today, we are jumping straight into the Q2 FY26 earnings call for Neogen Corporation, ticker NEOG. And you are definitely going to want to pay close attention to this one.
Oh, absolutely. You could argue this was the most critical call in the company's recent history. Neogen has been set up as this classic turnaround story, right? After months of cost-cutting, layoffs, portfolio cleanup.
And the result hit the wire.
And the stock just exploded. It soared nearly 32% pre-market on just massive volume.
Right. And a reaction like that kind of, violent stock move, it doesn't happen just because a company met expectations.
No, not at all.
It happens because the whole story, the core narrative, fundamentally shifts. So our mission here is to unpack the hard quantitative proof points management gave to justify that kind of repricing.
Well, the question going in was simple. Could this new leadership team, the one brought in specifically to fix things, could they actually execute?
And the market's answer seems to be a resounding yes.
Okay, so let's just start with the snapshot, the headline numbers, because they were clear, they were decisive. Neogen delivered just a significant beat on the adjusted figures.
Which is the signal everyone was watching for.
It's a signal that their big strategic transformation, that initial phase, is actually gaining traction.
So give us the numbers, the adjusted numbers the market really focused on.
Adjusted earnings per share, or EPS, came in at 10 cents. And it completely shattered the consensus on the street, which was sitting down around 6 to 7 cents.
Wow. Okay, so a huge beat on the bottom line. What about revenue?
Same story. Top line revenue was $224.7 million. That was comfortably ahead of the consensus, which was somewhere in the $207 to $208 million range.
So a clean $16-17 million beat on revenue.
Exactly. Massive beat on profitability, clean beat on revenue.
Now, this is where we need to be careful, because I initially saw the reported number and got tripped up. At first glance, reported revenue was actually down 2.8% year over year. What's the context there?
That's the noise. That's exactly the kind of thing you have to filter out. That reported decline is mostly because they sold off their lower margin cleaners and disinfectants business last summer.
An intentional portfolio cleanup.
It's intentional. And this right here is the most crucial signal for anyone watching this turnaround. You strip out those divestitures and the core revenue, it actually returned to positive growth, up 2.9% across the whole enterprise.
And that's the green light.
That stabilization is the green light the market was desperately waiting for.
So the JAP numbers are showing the messy surgery of the turnaround, but the adjusted numbers are showing the healthy patient underneath. Speaking of health, let's talk margins.
Well, you saw immediate operational leverage. The adjusted EBITDA margin improved almost 500 basis points.
Sequentially. From Q1.
Sequentially, from Q1 to Q2. To put that in perspective, that kind of jump in efficiency quarter over quarter in a business this big, it's the clearest sign that all that aggressive cost cutting is finally hitting the bone. It's driving real gains.
But let's be clear, because we are focusing on the adjusted health. But the company did report a GAAP net loss of 7 cents per share.
Exactly. And this just shows you the tremendous confidence the market has in the new leadership now. Investors looked completely past the GAAP loss.
Which includes all the one-off restructuring costs and things like that.
All the temporary non-cash items, yeah. They focused entirely on the adjusted numbers and that positive momentum. It tells you the street believes the GAAP loss is a thing of the past, and the adjusted metrics are the real indicator of where this thing is headed.
So the financial hygiene is improving. It's not just revenue growth, they're making it count. But where is this demand coming from? Let's break down the two core engines, food safety and animal safety. Because at 2.9% core growth, it wasn't even.
No, not at all. Food safety, which is their dominant segment, it clearly did all the heavy lifting. Revenue there hit $165.6 million. And critically, core growth reaccelerated to a very strong 4.1%.
And was this just them pushing price?
No, and management was really keen to point that out. They said the growth leaders, indicator testing, culture media, it was all volume driven. That suggests real underlying commercial strength.
Okay, and this is where it gets really interesting for anyone who's been following this company for a while. Petrifilm, that's their critical product line.
Yeah.
What happened there?
A huge recovery, a really nice recovery. It had been suffering from some distributor inventory issues last quarter, but it came roaring back to high single-digit growth.
So the end market is still healthy.
Very healthy. Management said they were seeing sellout data around 9%, which tells you two things. First, yes, the end market is strong. And second, they've actually fixed their previous execution problems.
Okay, so that's the good news. Let's look at the other side of the business, animal safety. That's the smaller segment.
Right, and that was basically flat. Core growth was a meager 0.1% increase, pulled in about $59.1 million in revenue.
So if food safety is carrying the entire company, what's going on with animal safety? What's the weakness?
That's the right question. So they did see good growth in biosecurity, specifically their insect control products. And they think they're gaining some market share there, which is a good sign. But that strength was almost completely wiped out by weakness in veterinary instruments like needles and syringes, and also some timing issues in their life sciences portfolio.
Got it. Okay, let's move back to the big picture margin and efficiency story. That's really the core of the investment thesis here. Gross margin was up to 47.5%.
Yep, up 210 basis points from Q1. They said it was mostly better volume leverage and, like you said earlier, lower tariff costs. If you exclude all the noise from integration costs, the operational gross margin was actually over 50%.
And what about cash?
Cash flow is also getting much better. Free cash flow was $7.8 million, which is an improvement of over $20 million from just Q1.
How'd they do that?
Tighter working capital and, importantly, lower capital expenditure. They're spending less. And they stress that routine CapEx should get back to more normal levels, maybe 3 to 4% of revenue, by late fiscal 26.
Which should mean more sustainable free cash flow down the road.
Exactly. Okay, so let's shift from the what the numbers to the why, the strategic changes. Because these financials, they're just the result of deeper changes in people and process.
And management made a huge deal about strengthening the leadership team. They didn't just replace people. They brought in some serious heavy hitters.
That's right. They highlighted the new CFO, Brian Rigsby, and a new Chief Commercial Officer, Joe Fells, who is a very seasoned diagnostics exec from Abbott and Cepheid.
Big names.
Big names. And a new food safety GM, a new head for North America, a new Chief Strategy Officer. The message was loud and clear.
We're bringing in leaders with a disciplined, fundamentals-focused approach.
A total culture shift.
It's a structural correction to the old culture that kept missing forecasts.
The CEO gave this really fascinating insight into how they're improving execution. He said the biggest change was moving from these comfortable monthly forecasts to a weekly, latest best estimate process. And that's not just a small tweak. That's a huge managerial shift. When you move to a weekly, detailed process, you're driving real-time rigor and focus. You're forcing managers to be predictive, not reactive.
Pushing accountability down to the account level.
Exactly. And that's what's letting them deliver that predictability and consistency the CEO keeps promising investors. It's not magic, it's just better process.
Which then supports their bigger strategy of solutions-based selling.
Right. They pointed out that over 75% of their food safety customers already buy multiple product categories. So the goal is to use this new commercial rigor to sell them even more, which increases, customer stickiness.
Okay, so beyond the commercial side, let's talk operational fixes. This is the tangible proof the market needed. They talked about two big manufacturing headaches. First, the sample collection product line.
Which has been a huge drain on margins, a huge drain.
And the numbers they gave here were stunning. They quantified it. It was a $10 million headwind back in Q4. That got better, down to a $6 million headwind in Q1, and now in Q2.
Down to about $3 million.
The trend is obvious. And this fix is totally within their control, right? Doesn't matter what the macro environment is doing.
Totally. And the expectation now is that this product line will become a positive contributor to gross profit in the second half of this fiscal year.
That swing is massive.
But
hold on, isn't that kind of conservative guidance a red flag? Like, they aren't fully confident that this momentum can continue.
It's a valid question. But you have to remember their history of missed forecasts. Management is prioritizing credibility over hype right now.
Under promise, over deliver.
Exactly. They said the caution is because they want to build trust, the new team is still settling in, and there are still macro weaknesses out there. The CEO is focused on predictability. For a turnaround story, that's what investors want to hear.
And speaking of those macro headwinds, they are very real.
Absolutely. In food safety, they're still seeing disruption. Global food production volumes are generally down. There have been bankruptcies, plant closures. And in animal safety, U.S. production animal herds are at record lows.
So a tough backdrop for this turnaround.
A very tough backdrop.
Okay, finally, the portfolio cleanup continues. They're still planning to sell off the global genomics business.
Yep, moving right along. They expect an announcement in Q4 of this fiscal year.
And the money from that goes where?
Priority one is accelerating debt reduction. It simplifies the balance sheet and lets them focus on the core business. It's really the final piece of the turnaround playbook. Commercial rigor, operational fixes, and smart financial engineering.
All right. Before we wrap this up, it's time for our favorite segment, where we pitch an outrageous but plausible trade idea based on what we just heard in this call.
Okay.
This is not financial advice segment. And let's be perfectly clear. This is purely for entertainment. It's a thought experiment. We are not recommending you buy, sell, or short a single share of Neogen. Please, do your own homework.
A firm and clear statement. Okay, let's hear the pitch.
So the market just traded this as the big inflection moment. Stock up 32%. That's phase one. Confidence is back. Phase two, which we just covered, is all about margin expansion and deleveraging.
So you're betting on the known operational fixes.
Exactly. The pitch is to short the macro, long the execution. We know they're executing on these internal fixes, especially that sample collection optimization. We know the genomics sale is coming in Q4 for debt paydown. So given this new management's focus on discipline and their conservative guidance,
You think the EBITDA target is a floor?
I think that $175 million target is absolutely a floor.
So what's the outrageous part of the bet?
The outrageous part is betting that they surpass that $175 million EBITDA guide by at least 10% by year end, and that it's driven purely by internal efficiency gains overcoming all that external macro weakness. I mean, just think about the sample collection fix alone. It goes from a $3 million quarterly headwind to a profit contributor in the second half. That annualized swing is a massive margin tailwind that management controls, not the global economy. The trade is simple. Bet that the CEO can pull those internal levers faster and harder than the market currently expects.
Turning that gap loss profitable sooner than anyone's models are projecting.
Exactly.
A bet on process over prognosis. I like it. A compelling model.
So to recap this whole thing, Neo had navigated a critical quarter. They delivered the beats, they raised the guide, and they validated the new management team's entire strategy.
Yeah, the stabilization in core growth, especially that Petrifilm recovery, it suggests the new discipline is firing up the commercial engine again.
The bottom line is this. Management is now forecasting positive growth for the full fiscal year. That's huge. The thing to watch now isn't just the long-term FY27 Petrifilm transition. It's whether this new leadership team can convert their conservative second-half guidance into another operational beat.
Right. Is this the start of a sustained, predictable trend? Or was this just one really good data point in a choppy turnaround story? That's the billion-dollar question.
Something critical for you to think about as you build out your models. Thanks for joining us for this deep dive into the Neogen Q2 FY26 earnings call. We'll catch you next time.